Alright, my name is Cody Oldendorf. This is my Finance 653 project. I analyzed 3 different industries, 5 companies each industry. The first one will be airlines, the second will be sporting goods, and the third will be gaming. Alright, so the airline industry, I decided to go with Southwest Airlines, Delta Airlines, Spirit Airlines, JetBlue Airways, and Allegiant Travel. So let's first off look at their liquidity ratios. Okay, as we go through the liquidity ratios, we really want to look for numbers that are close to 1. Whether it's above or below is not that big of a deal. You prefer above, but closer to 1's better. As you can see, you have Southwest, Delta, and JetBlue are below 1, and most of their money looks like it's in cash. Spirit and Allegiant are both above 1 in every ratio, and I kind of like Allegiant's numbers better because Spirit's may be a little too high. They may have better opportunities elsewhere that they're not taking advantage of. So now let's look at their long-term solvency. Okay, as we look at the long-term solvency, we have your equity multiplier and your cash coverage ratio. Your equity multiplier lets you know how much debt you have as compared to equity. Delta seems to be a lot higher. The industry average is low, it's about 4. Delta's kind of pushing the number up a little bit, but everyone else is kind of lower. Another thing that stands out, we have Southwest is a 20.85 cash coverage, really good number. As far as Allegiant does too, and that just represents the fact that they can afford more debt if they decide to take on. Spirit has a negative, has NA. That just means they probably don't have too much interest expense. Maybe this year they didn't have any at all. So now let's look at the profitability. Okay, as we go through profitability, we're going to break down ROE. And we're going to go through the numbers. Okay, we're going to look at EBIT margin first. 2 that stand out right away, Spirit and Allegiant. That's a very good sign of good management when you have a high EBIT margin. So those are 2 really strong numbers. Tax burden, everyone's pretty close to the same. The only one that really stands out is Delta. That's a big tax return. They did have some bad years in the past, so it makes sense that they had back taxes, and so basically they get a refund. Interest burden, that has a lot to do with the amount of debt you have. I like a higher interest burden. We keep more of our EBIT, so I like that number. And then the profit margin comes from the EBIT, tax, and interest. Obviously, if you have some bigger numbers, like Delta's a little skewed because a 417 tax burden you're really not going to get all the time. So they're a little higher than everybody else. Asset turnover, again, 2 numbers stick out to me. Spirit and Allegiant. Those 2 companies have done a really good job of not only their EBIT margin, but asset turnover. Spirit again comes up ahead, and then we hit ROE. Good thing industry, they're all positive. You like to see that. You have Spirit and Allegiant again leading the pack, and then Allegiant kind of catches up a little bit with Spirit and ROE because they took on more debt. So it magnifies their gains a little bit more. And Delta actually has a no ROE. It's because in years past they had a negative equity. So it'll be a few years before their numbers start coming around. Now we're going to look at the market ratios. I like a high PE, but not too high because I'm looking for a company I can invest in and kind of buy low. So Delta is kind of interesting. They're at a 10, which means the market really isn't that confident in their future, which they've had some bad years since the '08 crisis. So I don't blame them there. They also have a very high EVA, but I think mainly that's from they're trying to pay back their shareholders because they lost so much of their money. So again, the other 2 that stand out, Spirit and Allegiant. They seem to be on top of most categories in here. In the EVA, Spirit comes ahead of Allegiant. If I had to pick between the 2, because it's obviously going to be between Spirit and Allegiant, I think I would go with Allegiant. And I know they've had lower numbers than Spirit according to their 2013 numbers, but in the past 5 years, Allegiant's been growing consistently, and they haven't had any negative numbers. Spirit in around '09 and 2010, they did have a few bad years, so they are turning around. And these are obviously really good signs, but I think I'm going to go with somebody who's a little more consistent. So that industry, I'm going with Allegiant. The next industry I did was sporting goods. We have Cabela's, Dick's Sporting Goods, Hibbett Sports, Big Five Sporting Goods, and Sports Authority. Now, Sports Authority really is slacking in this industry. So as you'll see, a lot of their numbers are negative, and the other companies are really very profitable. So let's look at liquidity. Very good liquidity numbers. Makes sense, retail industry, that all the companies are going to have above 1 current ratio, and most of it, if not all, is going to be in inventory. So we have good cash ratios. You have Big Five and Sports Authority are really low in cash, but Hibbett Sports is a pretty good number. Cabela's, I think, is at 4.48. That's a little too high. I'm a little uncomfortable with them having so much inventory. I really couldn't tell you why they would do that. But usually you're looking for around a 1 in these ratios. But I think with it being retail, I kind of want a little higher. So Hibbett Sports is really at a good area, and so is Big Five. But I think if I was going to be the most confident in any of these, I think Hibbett Sports has really good numbers. So now we're going to long-term solvency. Again, we're looking at equity multiplier and cash coverage. The equity multiplier numbers are again kind of low for this industry. Sports Authority take on the most, and you'll see how they pay for that later. Cabela's is a little higher than everybody else, and Dick's Sporting Goods and Hibbett Sports are really low. But a big number to point out here is Hibbett Sports. We're at a 708 cash coverage ratio. I mean, they can afford so much more debt to multiply their ROE, but for some reason they don't do it. So maybe that's something they should think about. Also, you have Dick's Sporting Goods is at 107. That's also a very high number. Cabela's is coming in at a 17. They could also afford more, but it's definitely not as big as these two. Now on profitability, we'll see where some of these companies really take off. Okay, you have Sports Authority, again, is struggling. They have a negative EBIT margin, which means usually bad management. They're not really doing well with their operating expenses, which is not a good sign. Because of that negative, they have a bad profit margin, a negative profit margin, which obviously goes across to ROA and ROE. So now let's look at Hibbett Sports and Cabela's. Now Hibbett Sports is a 14.17, best EBIT margin, obviously a really good sign. Tax burden, they're all kind of equal except for Sports Authority, but they're all kind of the same area. You know, that's something you can't control. Interest burden, they're also all kind of high just because a lot of them don't take on too much debt. So we take those numbers over to profit margin. Hibbett Sports has the highest, and then we get to asset turnover, and that's a really good number to have at 2.37 for Hibbett, because that tells you how much money they're making on on the number of assets. So I really like that Dick's and I like that Hibbett are pretty high numbers, along with Big Five Sporting Goods. Cabela's a little disappointing for me being that low, but I can live with it. So now we go to ROA, and you really see here that two companies that are doing the best are Dick's Sporting Goods and Hibbett. And then when you think about it, Dick's has just about a little more equity than Hibbett, and it about doubles to ROE. But then you look at Hibbett, and they're at a 32 ROE. That's way ahead of the game. And that's also with very, very, very little amount of amount of debt. So it's really, if they were to take on more debt, which they can afford with their 700 cash coverage ratio, that number could go up astronomically. Now let's look at their market ratios. If you take a look at the market ratios, again we have PE. Now looking at PE, they're all pretty equal. Obviously Sports Authority doesn't have one because they didn't have, they lost money last year, so negative earnings. So Sports Authority also has a negative economic value added, which would make sense. We look at the other ones. Dick's. Dick's has a good EVA. You like to see that as an investor. You want to see them make it above and beyond what you expect. But Hibbett and Big Five both also do that. Now Cabela's is negative, but still it's not that far off. I'm not too disappointed if I'm an investor. So when I'm going to pick the company I like most, it's obvious that I have to go with Hibbett. Their PE is, just about as close to Cabela and Dick's, and their ROE is above and beyond the others in the company. The past 5 years, they've at least had an ROE of 20, and no one else in the industry has had a 20 in the past 5 years. So obviously Hibbett knows what they're doing, and it's a really good investment opportunity. So now let's go to gaming. Last industry. Here we have MGM, Boyd Gaming, Penn, Olive Capri, and Pinnacle. Alright, let's start off with looking at liquidity. Looking here, I like what I see. They're pretty close to 1 in most of the categories. It looks here that a lot of them have most of their current assets in cash, which is a good sign if things sort of go bad. So they're all pretty close to the industry average. Pinnacle has a pretty good number. I think I like MGM's the most. It's the closest to 1, and also the quick ratio looks good too. So, but really no one stands out when you're looking at this point. Now for the long-term solvency, again, equity multiplier, cash coverage ratio. Looking at equity multiplier, they're kind of all over the place here. You have the lowest is at a 2.6 with Penn. Then you have your highest at 15.6 with Boyd. A lot of these companies are finding different ways to try to make money. Then we have our cash coverage, which tells me one thing, that basically, although their equity multiplier is different numbers, they're all running about as much debt as they can, which is kind of concerning. Then you have Pinnacle, who comes in with an 11 equity multiplier, but they don't even have a cash coverage ratio, so that's not a good sign either. Now we head on to profitability. You can already see all the negative numbers standing out. You have good signs, but if you look down the list, ROA and ROE are negative all the way down. So that's obviously not a good sign for the industry. I would argue that a lot of it has to do with the tax and interest burden, although they do control parts of the interest burden. That's partly their fault. Tax burden you really can't control. But the things they can control, they are doing decent at. Now, EBIT margin, 10.32 industry average is a really good average. I like seeing that. I like seeing good management. Asset turnover, again, they really don't have that much assets. I guess their fixed assets is really what it's looking at here. And you'd like to see higher numbers, but again, at least it's positive. They're making money off of some of their assets. So, but if you look at the interest and tax burden, obviously, big numbers in both categories. MGM's getting hit hard by the tax burden, but that could mean in future years they really won't have that problem. They also have an 8.21 interest burden, which you would think is bad, but at least it's not negative like the rest of the companies. So bring all those numbers over, we have negative ROEs, and now if you remember we were doing the equity multiplier, you can see how it multiplies the numbers across. So as you're losing money, it looks even worse when you're doing it with debt. So now let's go over to the market ratios. Now looking at the market ratios, again, we have negative price to earnings ratios. Not a good sign. Negative earnings in the past. Pinnacle shoots up right here. It's kind of interesting. I guess they have investors really think highly of them in the future, which could be a good sign. EVA, also all over the place. Pinnacle does have a high PE, but they have a very low EVA, which is not something you want to see as an investor. You at least want to see a positive number. But if it's negative, let's not make it too bad. So this industry, it's really tough to pick a company. The industry really is it's not doing too well. So if I had to pick, I think I'd have to go with MGM. I think their liquidity ratios are really nice. They have a good EBIT margin, a positive asset turnover. And the thing that really stuck out with me is their problem was the tax burden, which a tax burden like that won't be something that you carry year to year to year. So eventually it should stable out if they continue to earn money. So I think if I was going to pick a company here, I'd go with MGM. Now, from an overall investment decision, I think I have to go with Hibbett. Hibbett had astronomical numbers compared to the rest of their industry. And not only do they have the best ROE of all the companies that I did across industries, but they have opportunity to make more money by their equity multiplier because their cash coverage is 700. So their PE is relatively low, about the same as other companies. So I think at a 20 PE, I'm really liking that number. So if I had to invest in somebody, I think in the very end it's going to go with Hibbett. I think they're going to make me the most money.